It's a bit of a surprise to me because there are a number of discouraged fresh graduates that went back to their home and stopped looking for a job. But I can also see the efforts from all levels of government. They try to expand the government employment and ask SOEs to take in as many workers, new workers as possible. So it is a result of improved government effort, not really improved economic fundamentals. And this year, there will be more fresh graduates coming out. So, yeah, it's going to be challenging.
Exactly. And if you're talking about college graduates, so this data comes with a caveat, at least from the line that I'm picking up on Reuters. It says, let me get it to you verbatim. It says basically that the youth unemployment number for December stands at 14.9%, excluding college passouts. You want to react to that very quickly? I just want to pick that line. I just missed it. Yeah, okay. I got it. So the survey-based jobless rate for the age of between 16 to 24 stands at 14.9%, excluding college students.
Well, that is relatively lower than the market expectation. But for low-skilled job workers, it's not very difficult to land on a job. It's just the average wage is pretty low. For high-skilled work jobs, it is a lot more difficult to land on a good one because IT industry is shrinking, finance industry is shrinking. But if you're looking for a service job in the cities towards the lower end, it hasn't been very difficult in 2023.
They're not the jobs that people want, and AI is probably going to disrupt that even more. Can I just ask you, though, because, you know, and we've talked about this so many times before, but just in terms of we have so much stimulus that has been afforded, and everyone can talk about the lags in transmission, but realistically, it should start to show up more resoundingly than what it has been. And that would be indicative to me, vis-a-vis a reaction function, that things are a lot worse than perhaps they appear at face value, especially when you look at numbers like these, and especially when you're seeing just these marginal month-on-month incremental gains. So is this going to provide any kind of an impetus that there just has to be something big? You know, do what the West has done, and I understand all of the troubles that come along with that. But if you want to see something substantive that's going to encourage speculation, again, it's going to drive asset prices, that needs to be, you know, you need to pull the trigger on the bazooka.
Well, the monetary and fiscal policies last year were actually quite conservative. Credit issuance from the banks were lower than the historical average. Given that we're in such a deep economic downturn, actually we should have seen more interest rate lowering and more fiscal money spending on all levels of government. But we know that China, all levels of Chinese government is pretty much deeply in debt. And a lot of the big infrastructure spending couldn't really start as soon as they would hope they wanted. And that means we probably won't see the kind of rebound or economic momentum like a lot of market participants have been wanting to see. But the bright side is the central government is taking over some of the debt, and they're keen to help real estate developers to finish the construction. So this year, I would think the investment side, the situation will be better than last year. But the consumption side is probably going to be more difficult.